Hello guys, welcome back to ESENtaxa. Andrea Papeto here, and in this video I'm going to explain you how to exploit the double taxation agreements among the European countries, but also among the worldwide countries, and pay less tax possible with a very technical element that tax accountant, tax consultant uses to help individuals to reduce their taxes and to understand in advance what type of taxation, what is the level of taxation you're going to pay if you are planning to move to a specific country. And this is what we do here in ESENtaxa. We help people to understand how is the taxation level through tax simulation, and thanks to those numbers you will understand if tax-wise that specific country in Europe makes sense for you or not. In the description below the video you will have our calendar link to know about our services, tax consultancy or tax simulation specifically, if you want to have a clear understanding about your taxation level, like a simulation if you were already living in the country you're wishing to move to, okay? Now, in this specific video I want to be as clear as possible, and I'll try to make this technical thing in the agreements documents as easy as possible for non-technical person, for not tax consultant. You that you're watching this video, you don't really need to know all the technicalities behind our job. We just want to understand in easy manner how we can exploit those documents and allow you to make the right decision, okay? Now, let me explain you this concept. Whenever you move from a country A to a country B, it's possible that you have to bring with you your incomes that you were receiving already in your country A, okay? So, most likely you have passive incomes based on rental income or interests or capital gains, dividends. So you have a certain kind of incomes that you have with you. You live out of them, you pay a lot of taxes in your country of origin, and you want to move in a country B, and you want to understand in advance how much taxes I'm going to pay in this country. You also might have chosen another country, country C, country D, country A, etc., etc. So you have on the table several options, and you want to understand which is the best taxation based on your type of income that I'm receiving already, okay? So I have my situation. I have in country A, then I want to move in country B or C. Maybe I don't know, between those two countries, which could be my best decision, which could be my best destination tax-wise. Now, the first things that we check in the convention to avoid the double taxation, why we check this document? Because when you move in a country B or country C, this new country wants you to be taxed on worldwide income. But at the same time, you're receiving income from country A. And the country A anyway tax those incomes on territorial basis. Because whenever you produce an income from country A, this country has the priority of taxing your income first. And then you have to tax again this income in your country you're moving to. But thanks to the convention to avoid the double taxation, you avoid to be taxed twice. Okay, so this is the concept. And normally we have two ways to avoid this double taxation through two methods. The tax credit method, okay, and the exemption method. Exemption with progression. It's called most commonly known as with progression, okay? Now, what's the difference between those two methods? And here relies the tax advantages, okay? If you're moving from a country from country A to country B that applies the tax credit method, so the new country in which you're moving to, on your worldwide income applies the tax credit method, you always have to rely on the taxation level of the country B. Alright? While if you're moving to a country C, and this country C has an exemption with progression method, your worldwide income will be based on this method, right? Okay, now what is the difference between those two methods? The tax credit is a very simple concept. I pay taxes in B, based on B level, based on average taxation level in B, and then I subtract what I have already paid on territorial level on country A. So tax credit means this is the level of taxation, and I'm going to pay that level of taxation, and my only thing is that I can deduct what I have already paid. But at the end of the day, you always rely on country B taxation level. Country C instead, using the exemption progression method, says, if you have an income already taxed in country A, I'm not going to tax this income. So you still declare your worldwide income on country C, but one country C sees that your income has been already taxed, no matter what percentage, but has been already taxed, has been considered taxable on territorial basis on country A, C doesn't tax it. Okay? So this is the exemption meaning. And the progression means that this income is not taxed on country C, but will be taken into account if you have other incomes produced in country C, and makes the global your global revenue as indicator to apply the higher tax bracket system in country C, okay? Like it would be already taxed in country C. This is the concept. But here's the trick. If you plan very carefully your relocation, and if your specific situation has a specific structure, for example, you have only income from rentals in country A, and you don't want to have income from country C, because you just want to live out of your passive income, which is a classical case, then country C doesn't tax you anything. And you always pay tax on country A, most probably on the reduced taxed, because you're not anymore resident. And most of the cases, the convention to avoid double taxation not only gives you the tax credit method, but also give you a lower taxation bracket here if you're moving, if you turn yourself as a tax resident into not tax resident. Okay? I think I made myself clear here. Here we have two methods to take into account: tax credit and exemption. If you have multiple income, also from other countries, not just from A, but country D, country F, you have multiple income that flows in the new country of destination. If all those in those countries have a convention to avoid the double taxation with the country of destination using the exemption method, you don't get taxed in your new country. You always get taxed at the original level, okay? And most likely the taxation at the original level could be lower. And the exemption method is extremely interesting because it says if you have already a taxation of your income, it doesn't matter how much. It's just what matters is that it's considered taxable. So I can always get some rental income taxed in Bulgaria, for example, at 10%, and I can move into France that applies the high taxation level, but I'm always get taxed in Bulgaria on my income, and in France, if I don't have any incomes, I don't pay any taxes. I declare on worldwide income what I get from Bulgaria, but I don't get taxed because they see that has been taxed no matter how much in the country from which I'm receiving the income. So this is a very technical thing in this video. I was trying to be as clear as possible, but if you want to planify correctly your relocation to a different country, you have to consider which is the method to avoid the double taxation to allow you to improve your taxation, to minimize your taxation at your individual level, okay? It's extremely important that we always analyze, whenever we do any kind of tax simulation, which is the taxation agreement between the country of destination and each and every country from which you're receiving your income. Be careful that in most of the cases of exemption with progression cases, the rental income, for example, that you're receiving from the country A must be taxed at least of something, or even if it's taxed zero, but it has to be considered taxable, because if it's not, then the entire income will be taxed at the high rates of the standard rates of the country of destination. Okay? So exemption with progression means you have a huge chance to pay less taxes or reduce taxes, but always better to pay a little bit in order to not have the problem of tax entirely your income in the country of destination. One of the countries in Europe that uses the exemption method with progression is Belgium, Norway, Germany, Bulgaria, Romania, Poland. So we have several countries in Europe that uses this kind of system, okay? So if you want to know more, and if you want to have a tax simulation in the new country of destination, and you want to check exactly for each type of income, which is the method that we can apply, You can book a consultation with us and we can understand with you together if the relocation in that specific country in Europe makes sense or not based on the convention to avoid the double taxation. Those documents are extremely important and we read in ESENtaxa carefully those documents to understand if you can squeeze your taxes, reduce them as much as possible, exploiting this kind of situation, this kind of method, okay? This kind of technical tax agreements, okay? And if you want to know more on ESENtaxa, subscribe to the channel, notification bell, a like button to help us grow as a channel. And as I said, I repeat again, in the description below the video, our calendar link to book a consultation with us and understand, again, if your tax structure as individual level, it's good or bad for a specific country of destination. Thank you for watching this video. See you the next time. Bye.